Most people think the Federal Reserve controls the economy. If inflation rises, they just raise interest rates, and if the economy slows down, they just cut rates, and it's that easy. But a few years ago, after more than a decade of stimulus following the '08 financial crisis, the Fed tried to stop printing money, and what we saw was chaos. The markets started to crash, funding systems seized up, and the government couldn't afford to service its debt, and parts of the financial system really begun to break. So the Fed reversed its course. They cut rates even lower, they injected more liquidity, and their balance sheets got even bigger. And that raises the question, are central banks actually in control of the system, or are they trapped by it? And by the end of this video, you'll understand why central banks are stuck in a position where they're not able to stop printing money. But before we get into that, let's talk about what people actually mean when they say the Fed is printing money. Because they're not talking about actual physical cash. They're talking about something called quantitative easing, or QE. The way it works is the central bank creates new bank reserves through digital money, literally by just adding numbers to the banking system. Then it uses those reserves to buy assets, usually government bonds or mortgage-backed securities. So investors and banks, they'll sell those bonds to the Fed and they'll receive cash in return. That cash now moves into the financial system, and it gives banks more liquidity, and it allows credit to become easier to create, and asset prices tend to rise. This process expands the central bank's balance sheet. On one hand, it now owns more bonds, and on the other hand, banks hold more reserves at the central bank. And the scale of this expansion has been enormous. Before the '08 financial crisis, the Fed's balance sheet was about $900 billion. After the crisis, it grew to $4.5 trillion. During COVID, it peaked at about $9 trillion. And today, it's still around $6.5 trillion. The Fed tried to shrink it from that $9 trillion peak, and they got it down to about $6.5 trillion, and then they slowed down. Because every time central banks try to remove liquidity from the system can't handle it. And what you have to realize is the Fed is doing their hardest to not trigger a recession or a collapse. Now, to get back to why central banks can't stop printing money, the first major problem is debt. US federal debt is about $38.5 trillion. Right now, the average interest rate on that debt is roughly 3.4%, which already costs the government about $1 trillion per year in interest payments. That's nearly 20% of all federal tax revenue. But the problem is, if interest rates move back towards historical averages around 5 to 6%, the cost of servicing that debt would explode. At 5%, interest costs would be close to $2 trillion per year. At 6%, they would exceed $2.3 trillion. That would make interest payments one of the largest spending categories in the entire federal budget, which creates a major problem. If central banks raise rates high enough to fully fight inflation, the government's debt becomes far more expensive to maintain. So the central bank faces a difficult trade-off. Fight inflation aggressively or keep interest rates lower so the government can actually service its debt. Economists call this fiscal dominance, when government debt becomes so large that monetary policy starts serving the needs of the government instead of the economy. And this isn't just happening in the United States. Japan's debt is over 250% of GDP, Italy's is about 140%, and countries with that much debt depend heavily on low interest rates to remain stable, which makes it very hard for central banks to keep policy tight for long. Another major problem has to do with asset prices. Over the past decade, financial markets have become heavily dependent on low interest rates and abundant liquidity. A large portion of Americans' net worth is tied to stocks, real estate, and bonds. And those asset prices are extremely sensitive to interest rates. We saw this clearly in 2022 when the Federal Reserve raised rates aggressively, and financial markets reacted immediately. The S&P fell nearly 20%, the Nasdaq dropped more than 30%, and bond markets had one of their worst years in modern history. That's what tighter monetary policy does. It lowers asset prices. But falling asset prices also create economic problems. When markets crash, consumer confidence drops and people feel poor. So spending starts to slow down, businesses start to cut investment, and unemployment rises. And historically, when markets fall far enough, central banks always step in. We saw this in the 1987 crash, we saw this in the '08 financial crisis, and even the 2020 pandemic. Each time, the response was the same: lower rates and more liquidity. Over time, this created something called the Fed put, the belief that if markets fall far enough, the central bank will step in to support them. This makes it extremely difficult for central banks to keep policy tight for long. Something else that you typically don't hear people talk about is that modern financial markets rely heavily on short-term funding. Every day, trillions of dollars move through something called the repo market. This is something institutions use to borrow cash using treasury bonds as collateral. These markets depend on ample reserves in the banking system. But when central banks try to shrink their balance sheet and remove liquidity, problems in these markets can appear quickly. We saw this happen in September of 2019. The Federal Reserve was shrinking its balance sheet through quantitative tightening when suddenly repo rates spiked to 10% overnight, even though they normally sit at around 2%. This caused the Fed to intervene immediately and start injecting liquidity again. That situation revealed something important. The modern financial system has become dependent on central bank liquidity. And if you remove too much of it, you're going to start to see the cost of borrowing money shoot up rapidly. And that'll have ripple effects all throughout the economy. The Fed also feels pressure from the government at times. Even though technically the Federal Reserve is not a part of the federal government, the government still benefits enormously from low interest rates. Lower rates make it cheaper to service debt, they make it cheaper to run deficits, and they allow governments to spend more without raising taxes. So politicians, they often pressure central banks to keep rates low. And the pressure isn't always subtle. In 2019, President Trump publicly criticized the Federal Reserve for raising rates and demanded cuts. In 2025, he again called for lower rates to reduce federal interest costs. Similar pressures exist in other countries too. The European Central Bank has faced pressure to support heavily indebted countries like Italy and Spain. The Bank of Japan has gone even further by actively controlling long-term bond yields to help the government finance its debt. Central banks are supposed to be independent, but in reality, they operate inside a political system. And when higher interest rates start causing economic or fiscal stress, political pressure quickly builds to ease policy. That makes central banks trying to run tight monetary policies even more difficult. So, what actually happens when central banks keep the money printer running for years on end? There are a few major consequences. First is inflation. When large amounts of money enter the system for long enough, it eventually shows up in prices. We saw this clearly in 2021 and 2022 when inflation hit 9%, the highest level since 1981. Second is wealth inequality worsens. Policies like quantitative easing, they tend to raise asset prices, especially stocks, real estate, and bonds. But asset ownership is heavily concentrated. The top 10% hold majority of those assets, while the bottom 50% of people, they own very little financial assets. So when asset prices surge, the benefits flow mostly to people who already own those assets, and it makes the wealth gap even bigger. The third major consequence is something called zombie companies. When years of extremely low interest rates, they basically allow weak or unproductive companies to survive by constantly refinancing cheap debt. And those companies, they tie up capital and labor that could otherwise flow to more productive parts of the economy. So while cheap money, it can stabilize the system during crises, over time, it can also create deeper structural problems that weaken the economy in the long run.